Hey guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. Today we're going to be talking about Fiserv and PayPal. This is a preliminary analysis. We're going to be giving our thoughts about it. We're going to plug it into the model.
Request.
Yes, it is a subscriber request. We're going to plug it into the model, take a look at it, and then we're going to give some thoughts about it. So
we're going to make this video more or less brief because it's fairly simple relative to the other videos that we made with the VIEs.
Yeah.
Like interactive brokers. So for this one, I think we should just jump right into the models.
Let's do it. Yeah.
All right. So at the end, Austin, I want to hear, your thoughts as to, are you buying it? You're not buying it?
Yeah. Well, while you're kind of going through the model, I'm going to sort of look now at what the business does,
So you don't know what PayPal does?
Well, I know what PayPal does, but I got to look at what Fiserv, Clover and all this other nice stuff. I got to kind of like see beyond the surface.
Okay, we're getting all our loading. It's loading. There we go.
The model just never loads.
Stays loading. All right. So we got buy rating for analysts, price target of 281, implying 52.8% upside. If you trust them, there you go. That's the analysts, not us. So let's assume a buyback. Let's start from the get-go, and let's assume that they're able to do 0.54%, which is like,
dude, this website is pure cringe. Their links literally don't work.
The PayPal website?
No, the Fiserv website.
Oh, yeah. Well, they don't really care. It's not meant for you. They're not a consumer-facing company.
Yeah.
So, yeah, we have a pretty decently sized company, $216 billion market cap, fast growing, 17.8% average growth rate. So I think that's fair to say that we can say that that's the average. So actually, I'll change that to, look at that. We're already there. We're pretty much already there. So if I imply 18% growth rate, we're pretty much on the today's price. So that's kind of telling me that's the implication of the market. The market's implying a 10% rate of return. So there you have it. If you believe that they're going to continue the average, okay, in terms of what they've been doing. And that's an implied 159.37% rate of return over the course of 10 years. And, I want to add that can be a little nuanced in terms of like, if there's a lot of over exuberance and the stock can actually get very overvalued, that is something that obviously you can't model out, right? Because has to do with sentiment. However, you can utilize the model or a discounted cash flow model or any kind of model that kind of alleviates that exuberance, and then it can kind of guide you whether or not this is a moment of exuberance and you should be thinking about trimming, for example. So like, for example, if I saw this get to like in the 200s and I was holding the stock, I would think about selling just based on the model, because I would say, well, the prospects of the returns going forward are not promising at the current price. So I should probably trim out my position. So, however, if I was already holding and at this price, I might actually would consider just holding, because it's still taking in the average market rate of return, but it's a consideration. It's, not set in stone. Now let's take a look. Let's see if they can get like 25%. So they actually accelerate, and then we'll say 22%. And then we'll say a lower of 15%, and then 12%. So at 10%, based on these assumptions, depending on how true you think they are, I actually would like to change this one to the 45 and this one to the 30. I should allocate at max about 2.9% of my portfolio. If I lower my assumptions and say, for example, this is the 22, and instead this becomes, for example, 20. Let's see what that does. You see now it says 0.53% of the portfolio. So the model is implying that at current prices, it's rather risky. And what's stark about this is that I'm only assuming a 10% rate of return. So let's actually do what I'll call, what a lot of creators use is 12%. So at 12%, we'd have to assume a greater than 22% rate of return for us to even consider it. But that's only assuming that specific scenario. that'd be a very aggressive set of scenarios if 23% is our low point, right? So
Yeah.
I'd be very cautious. The model's right now saying do not buy at all if you imply 12%. And see, it says the recommended weighting is, not there. If, for example, if we can assume a higher rate of buybacks, maybe that can change it a little bit. So like, but we don't want to rely on that. That over reliance. Okay, it didn't actually change. Let's go back. So then if I discounted at 15%, you can kind of see I really have to wait for a pullback in order to get that rate of return under the fundamentals, unless we do find out that the growth rate will actually accelerate going forward. That being said, something like a Visa or MasterCard, which actually deserve their own video, they'll always trade at a premium, or at least they have since IPOing, because of the moat and the power of what they are. But
Okay.
that's
So
like
what is that moat and power of what they are? What is that actually? Can we explore that for a quick second and just
Visa and
sort of,
MasterCard
yeah.
or
Well, I mean,
PayPal.
PayPal.
Okay, because
PayPal's.
Visa and
Yeah.
MasterCard, they deserve their own video. Sticking to
Yeah.
PayPal, because that's what we're analyzing.
Hmm.
PayPal is basically a payments service that consumers can use to protect themselves when exchanging in commerce online.
Yeah.
And then they've also have products like Venmo, which is, I think, one of the most popular products utilized by individuals to exchange money between each other. Um, it's very popular among the youth, and even actually not so much the youth. Businesses actually use it. So I was in New York City, and I saw a lot of street businesses using Venmo to accept payments from pedestrians. So we need to see PayPal, for example, and how they're getting into all these different avenues, and if they're doing so effectively and tackling the customer's needs where they are effectively, this could be further drivers of growth. Now, I know that PayPal, for example, is getting into a firm's neck of the woods. They're now offering, for example, payment in terms of splitting these payments so that customers can afford more expensive items than they normally could, or it allows customers that could otherwise afford it, they can just split up the payments, and that can be an effective form of financing. Well, whatever. It's basically competing with the firm at the end of the day.
Yeah. So
Um,
I kind of have a question here too. I'm sure that you've
yeah.
probably heard that PayPal was in talks of acquiring Pinterest, the social media company. What are
Hmm.
some of your thoughts on that? For me, I am not entirely too sure I understand really the purpose of acquiring this, unless that's just more so to just kind of have further outreach in the internet and sort of the social media realm that is so dominated by Facebook at the moment.
Well, Pinterest, a lot of people use Pinterest as kind of like a wish list of items. So if you talk to girls about, because that's the majority of people who use Pinterest are females,
Yeah.
and females like to use Pinterest for kind of like a shopping wish list. Like, oh, look, these are all the things I'm interested in. And then if PayPal can leverage that, so if they buy that out, they can leverage that and kind of target these women and allow them to purchase these items directly from the website. For
Ooh.
example, a lot
Okay.
of creators on Pinterest, people get followers, a lot of followers on Pinterest. We call them, let's just call them influencers. They actually can put links to products that they put on there, and you can go on their page and actually buy the product. So if PayPal can kind of, integrate that, that's what they're kind of thinking. And then that gives them exposure in the social media landscape to kind of get that consumer interaction on a more meaningful level. So PayPal is trying to build out an ecosystem. So PayPal as a company, I think it's a fantastic company. And if we take a look quickly at the key ratios before moving on to Fiserv, I'll just touch upon some of them because I don't want to make this video too long. See the
Hmm.
gross profit margins; those are pretty solid,
Yeah.
but the net profit margin is really good. 20% is fantastic,
That is that's
and it's
exceptionally good.
rising
Even
over time.
earnings quality is very very good for this company as
Yes,
well.
earnings quality is great. It's all fair and well.
Um,
I don't care about activity.
the cash ratio though, actually that's not.
No, no, no. Don't worry
No,
about
yeah,
cash
that's
ratio. Cash ratio is the
yeah.
most conservative of the liquidity ratios. Um, but the debt ratio is pretty good. We have a very solid balance sheet. Only just now have they been utilizing debt. Before, they were a debtless business. It's still very little debt relative to what they have.
Hmm.
So going back, I think it's a great business. It's just overvalued at the moment. They're
Okay.
already returning capital to shareholders, so they're past that phase of dilution. They're actually deleting shares over time, so that's a good thing. But we want to see the price come down before we consider adding a position. Otherwise, I'm taking on too much risk at this moment, making too many
Does not
assumptions on the growth.
satisfy the assumptions,
Does
as
not
you claim
satisfy
I
my
always
assumptions.
say.
So, Austin, what are your thoughts before I move on to Fiserv?
I like it. Yeah, just I need to do more research into this personally before I really come to kind of any concrete conclusions. At the moment, I would also need to do more research too before I can, because I'm willing to pay the premium if I can visualize where I could see the business going with these various acquisitions that PayPal is currently making, and PayPal is just a monster. But yeah, case in point, I need to do more research. So
Fair enough.
yeah,
So I'm going to assume the average of 10%. And I'll explain why. Well, because they've done buybacks of dilution of negative 16%, but average growth of 26%. So then you average that out as the accretion to the shareholder is 10%. Fairly simple. What was that? You don't like the word accretion?
no,
It's
it's
not.
just, it's just not loading.
Oh,
It's just stuck in limbo.
well, it's pulling Fiserv forward. There's also I have the sheet hidden, but it's I
There we
call it the
go.
Jedi Archives. Has every
Ah,
stock in existence on it. So
nice.
it actually it's sorting through them and then taking all of the competitors to Pfizer. I haven't added the feature yet. It's kind of like in beta,
Yeah,
like
beta, beta,
alpha.
beta,
No, it's
beta.
it's an alpha. It's like triple alpha. And
Triple.
yeah. And
Okay. So
but
basically, it hasn't been
it'll
developed yet.
show itself one day. So
Yeah.
one
All
day
right.
soon.
Nice.
So 10% growth rate. We're just about there, which is nice. And if we want to assume, for example, I don't think they're going to be diluting because you know what this was? If you had to guess, I told you they own something.
Clover.
Clover. It was Clover
Yep.
acquisition. So
Yep.
they made a big acquisition. Or it actually was company called First Data, which owned Clover.
Yeah. They need to fix their website because their
Also, no
links
one
should be
cares
working.
about you going on their website. Fiserv does not care about you going on their website.
I
They don't.
want to see the website
All right, you
features.
you want to see you want to see, for example, their consumer facing product, go to
Yes.
clover.com. There you go. You're welcome.
Yes.
Fiserv deals with banks. So Fiserv has the legacy business that is basically the financial software system for a lot of banks. And then
Yeah.
that's like on the back end, you're not going to be able to see that. But what you can experience as a consumer in the day to day is Clover. You go to a restaurant or a little boutique place, you'll see like the Clover stand. I think the majority of places I go to, they have Clover. I know Square is the competitor, but actually Clover is bigger than Square, which is funny. And then I think Square's was almost trading at double what Fiserv was. So Fiserv's market cap is $66 billion, and I think Square's was like 100 something $1 billion.
Mhm.
But that doesn't really equate. Both of them can be simultaneously overvalued. Okay. Some people like to say they point to an overvalued stock and they're like, well, that's that price and this is this price. This price should be that price, but they can both still be overvalued. Or it could just be that that one's overvalued and it's going to come back. But
Yeah.
so
Well,
it's
I
you
mean,
got to be
I feel
careful with
like a
that.
lot of people sometimes try to justify that with like sales multiples and all this other kind of stuff too. But
I do know they were actually raising capital through shares, so
Mhm.
share issuance. So I'm going to actually assume some dilution going forward and average it out to negative 2%. So that's going to worsen the results. So then I think on the high end term, they can grow at like 20%, and then so you see at 20%, we get our buy price, and I think they can actually grow 15% is quite reasonable. And then I'd actually be I'm gonna give it more leeway because I think 10% is actually a more conservative measure, and then I think we can say 12% is fair, and then on the low end 5%. So at current prices, this is kind of unfortunate because it's telling me that Fiserv is also kind of overvalued still, because I'm only discounting it at 10%. I am diluting it by 2% per year, but I am only discounting it at 10%. Because as soon as we go, for example, just to 12%, right here, immediately the model's telling me that the risks associated with the business at these assumptions, based on my requirements on return, I shouldn't be adding it to the portfolio whatsoever. And it's averaging out the risk and it's telling me negative 4.55% of my portfolio should be allocated at current prices. As the price comes down, this actually will increase in terms of allocation if these assumptions remain the same. So fundamentals remain the same and assumptions remain the same. This is different from the analysts, which analysts rated as a buy. So if you want to ignore us and go straight to the analyst, the analysts say it's a buy and the price target is $134.32, implying
Fabio,
30.
what is the forward PE ratio?
The forward PE ratio, I believe, is 17. Don't ask me how I memorize.
What's forward revenue growth?
The forward revenue growth by analysts,
Yes. Forward revenue growth.
I'm totally cheating right now.
The only thing I care about, forward PE
I'm totally cheating right now.
and
by the way.
forward revenue growth.
Forward revenue growth. Wow, that's garbage. They think it's
What
going
is
to
it?
be 2.95%.
Okay.
Terrible. I was wrong on the forward PE. It's 18.
Oh,
Oh
my
no.
goodness.
I must be sacrificed at the altar of the stock gods. All right, so
By the analysts.
yeah. So this is kind of what I'm looking at. We're looking at two good companies, but are just overvalued at the moment. I'd wait for pullbacks on all of these. We were seeing a strong fintech pullback, but a lot of fintechs, they trade very pricey relative to fundamentals. They didn't in the past. Like for example, you could have gotten PayPal way back when, and that was a fair value. The thing is that the stock price has advanced more than the business. You see? So like
Yeah.
at one point, if we backtrack the model, we can see that at one point it was worth something. But as it stands now, the stock price has advanced faster than that 17% rate of return or growth rate in the actual fundamentals. Does that make sense? It's actually grown, I think maybe close to above 20%, but the business fundamentals have only grown at 17%. You see where it's kind of going. So that's caught up to it over time, and then it got into a state of overvaluation. So in order for me to start a position, I'd have to see something. And then same with Fiserv. Fiserv also, either I'm going to have to assume, I know this is a popular stock from Rob, the Popular Investor, but this is one of those that I would actually probably disagree with him unless I'm not getting the growth rates right. And he's actually thinking the growth rates are much higher.
Picture potentially too. You know, that's also something that we have to take into account with this.
Yeah, like
So
my growth rates could just be off. And for example, this could be the 20 and then this one's like a 25. Well, even then, you see, like based on the assumptions I have here, the model's actually telling me an allocation of 0.28%. And I actually am using these weightings over here. So I'm weighting it more heavily in the 12% and above category, with 20% getting the highest weighting. So that could be wrong, by the way. But yeah, the weighting actually could be closer to 12% because I don't think this dilution will continue, but also this growth rate I don't think also will continue at the same pace because we can see here in the sales figures, you see this big jump, from 10 to 14, right? That's like a 40% jump right there, and then it just a 1 billion jump right there. So the growth rate's already slowed. Yeah, it's already slowed. It's starting to plateau. So it's not going to continue at 26%.
Well, I
So
mean,
this
we're
25%
also
is
kind
very
of
aggressive.
seeing almost an irregular story just in the growth itself. So if you scroll back down to the sales chart,
Yeah.
you know, like we kind of see like a period of plateauing between 16 and 17 and 18, and then a jump between 18 to 20.
But that's
and
the
then
acquisitions.
another period of plateauing. Okay.
Yeah, but that's the
Cool.
acquisitions. That's why it just suddenly jumps. It's not
Okay.
because it's the organic growth, which is a problem because
It
you
is,
want to
yeah.
see organic growth.
Literally, yeah. Like okay. That's interesting then.
Yep. So that's where we're at so far. If we can, let me see actually the price action on Fiserv because I didn't cover that one. but I think they did, yeah. So $80. Let's actually cross-reference that. $80 is actually close. It's between the 12 and 20%, which I'd be comfortable with actually estimating going forward. So if I could get it in that 80 range, I know that's saying, oh, we're going back to the pandemic or whatever, but even like all throughout 2019, yeah, all throughout 2019, that was like actually a decent price range. I won't go back further because by then the fundamentals were far less, but in 2019, the growth was already kind of kicking in. And you could have gotten, a decent entry point, but we'd have to wait for that to return. We're not that far actually, because it's only $100. We
Mhm.
just need a 20% drawdown from here, and then it'd be a interesting entry point. But at the moment, if you assume these and you require 12% rate of return, even assuming 2% dilution, allocation of 0.28%, which is like nothing.
Interesting. All right. Well, do you have any closing thoughts before I
No,
wrap
that's
up the
pretty
show
much
here
it.
today? All right. Well, this is the Capital Mindset Show. We are your hosts, Austin and Fabio. We hope that you have enjoyed what you have seen here today. If you have, please be sure to share the video. It really, really helps out the channel. Please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. And take care, guys.